Welcome back to the channel. As always, if you are copy trading, you are an absolute moron and you deserve to lose all your money. So today we're hunting for high probability trade ideas. In this particular stock, Kimberly-Clark Corporation, ticker KMB, is one that I find fitting into a value trap profile. If you're not familiar with the company, they are a household giant that you likely use every day. So they own Huggies, Kleenex, Scott, all these kind of tissue and diaper brands, which are normally seen as a safe defensive stock. But in this particular case, as you can see, the company has been struggling for quite a while, right? It's been sideways since 2019 and recently dropped from a key support level that they were trying to recover from. Having said that, we have to beg the question, well, could all the bad news have been released by now? Which definitely is reasonable, but I'll explain why I think there might be further pain ahead. So when we look at the world, the state of the world, where we are at the moment, first of all, there is a huge amount of uncertainty. But as we have seen here, especially with the SaaS winter that the markets have recently experienced, which coincided with the stock here going from under 100 all the way to 110, right? A lot of investors have been taking shelter in safe names like this. And that makes me think that the headroom, at least in the short term, might have run out. In the meantime, the company has actually been struggling with serious issues in their business model. So, in the household product sector, the power has shifted from the manufacturer to the retailer. So, in terms of how they go to market, they had what is called in the industry as the Costco divorce. So, they confirmed that they are losing their exclusivity at Costco for Haggis. So Costco is replacing them with private label Kirkland diapers, which is Costco's own brand. And management admitted that this distribution loss alone is a 60 basis point revenue headwind for 2026. So when you are a company struggling to grow organic sales above 2%, losing 60 basis points at one retailer is a leaky bucket scenario. The fundamentals as well are not looking great. So if we look at the numbers, we can see that when you look at, for example, the EBITDA plummeted by 20%. So in previous years, right, this company was generating north of 22. Then they struggled a little bit and recovered that, but now still in that sort of like losing territory. And of course, that has seeped through their bottom line, which has negative earnings growth, which is, of course, one of the reasons why we're looking at it. So when you look at, for example, how that reflects into other metrics like the enterprise value, it is well below the pre-COVID and pandemic numbers that were achieved. And cash from operations have been negative for 3 years straight and are actually accelerating. You also have CapEx increasing for 2 years straight. So that is definitely not good on the quant side. So analysts have officially lost faith in this stock. You can see how the floor on the lower end of the price target by the analyst community has been progressively moving down steadily, and so has the average price target, which at the moment the stock is sitting not very far from. So in terms of how this bodes for expectations, We can see that they are flat for this year and also kind of flattish for the upcoming year. But like I mentioned before, right, in terms of sales, this company is one step, considering the multiple in the sector that they're in, it's pretty much priced for perfection. They're one step from something going wrong for the fundamentals to seriously deteriorate. And that seems to have been picked up by the market too, because as we can see, the short interest has moved from around 1, right, progressively moving above the 10% mark over the last few months. So while that was happening, and this is why I put the box here, right, you see the short interest slightly going up over that period, and yet the price has gone up. So I think that presents an opportunity for an explosive move to the downside. So, to me, all these things, like I said, signal that the stock is at the moment a value trap. Management is currently in the phase 2 out of 3 of an next growth story. They're trying to sell a powering care transformation. But the reality is that the organic sales missed expectations in North America, contracting 4% in Q3 2025. And the company is under credit pressure. So S&P placed them on a negative outlook due to the KMB debt load, which is one of the reasons why we haven't seen the debt stay the same over the years. So any integration hiccup, like I said before, right, they're one step from something wrong to seriously put them into real trouble. Any hiccup in the next 3 months will likely trigger a formal credit downgrade. That's the next step. So what are we likely to see when we look at the stock? Well, we could see, for example, the data intra-quarter starting to show that the shelf space vacuum as Haggis are physically removed from Costco warehouses into full effect, right? That will confirm issues, further issues on the revenue. We also have some moves on the C-level suite. So the Chief Digital and Technology Officer is departing by the end of next month. And losing a tech lead during a $48 billion integration is a massive qualitative red flag, something to bear in mind. And as well, when we look at the price action, they're near a 52-week low. So a break below that level will trigger institutional liquidation. So for those reasons, I'm choosing to go short this stock over the next few days. Like I said, I'll typically structure that with options probably over the late spring and potentially over the summer. Hope you enjoyed the video. See you soon.